These are the 3 ETFs that could turn a small, consistent investment into a fortune, and they're simpler than you think. If you've ever felt overwhelmed by investing, picking stocks, timing the market, or stressing over every market dip, you're not alone. But here's the thing, the right portfolio doesn't need to be complicated to make you rich. In fact, history shows it can be as simple as 3 ETFs and still outperform most investors. In this video, you'll discover the updated 2025 version of the legendary 3-fund portfolio, the one that could mean the difference between retiring comfortably and leaving hundreds of thousands on the table. Most people still follow the old 1990s version of this strategy, and that's costing them big. I'll show you which funds to swap and why one change alone could double your long-term returns. We'll also run the real numbers, so you can see exactly how much $500 a month could grow in 10, 20, even 30 years, and why the results might shock you. I've spent years researching ETFs, breaking down their holdings, expense ratios, and historical performance, so you can invest with clarity and skip the guesswork. My goal? To give you a plan that's simple enough for beginners, but powerful enough to build serious wealth. By the end of this video, you'll know exactly which 3 ETFs to buy, how much to put in each one, and how this simple strategy could completely change your financial future. Let's start with the foundation, the ETF that's beaten the market 92% of the time over any 10-year period. When I think about building a portfolio that can actually make someone wealthy, I picture it like building a house. If you start with weak materials or a shaky base, no matter how beautiful the rest of it is, the first big storm will bring it down. That's why the first ETF in this strategy is what I call the foundation. It's the part of your portfolio that's built to be solid, to endure the ups and downs, and to quietly grow in the background for decades. For me, that foundation comes from either the Vanguard S and P 500 ETF, ticker symbol VOO, or the Vanguard Total Stock Market ETF, which trades under VTI. Both are phenomenal, and the choice between them often comes down to personal preference. VOO tracks the S&P 500, giving you exposure to 500 of the largest companies in the United States. VTI goes even broader, covering virtually the entire US stock market, thousands of companies big and small. Either way, you're owning slices of Apple, Microsoft, Nvidia, Amazon, Alphabet, Berkshire Hathaway, the household names that dominate the economy. Here's why this foundation is so powerful. From 1950 to 2022, the S&P 500 delivered positive returns in 74% of all one-year periods. Stretch that holding time to 5 years, and the odds go up to 83%. Hold for a decade, and you're looking at 92% positive results. And here's the kicker. If you held for 20 years, the S&P 500 has never been negative. 100% of the time, in any 20-year period, it made money. That's the kind of reliability you want in your core holding. The costs are also ridiculously low. VOO's expense ratio is just 0.03%. Which means you'd pay only $3 a year for every $10,000 invested. And with an average return around 9% a year, a simple $10,000 investment could grow to roughly $56,000 in 20 years. That's the rule of 72 in action. At 9%, your money doubles about every 8 years. Now, as great as that foundation is, it's not the part of the portfolio that's going to produce the biggest passive income or even the fastest growth. That's where the second ETF in this strategy comes in, the one designed to keep your portfolio safe, but also to pay you cash along the way. In the old version of the 3-fund portfolio, this safety role was usually filled by bonds. And while that made sense in a world where bonds paid decent interest, it's a different story now. Over the past decade, the BND bond ETF has returned just 1.6% per year on average. In the last 5 years, that number's even lower. Factor in inflation, and bondholders have effectively been losing purchasing power. So instead of parking money in bonds, I prefer a dividend growth ETF, something like the Schwab US Dividend Equity ETF, ticker SCHD, or the Vanguard High Dividend Yield ETF, VYM. These funds are built to invest in companies that not only pay dividends, but have a history of increasing those dividends year after year. That growth in payouts is critical because it means your income rises over time, even if you never add another dollar. Let's take SCHD as an example. Over the last 10 years, it's averaged about 11.5% annual returns. On top of that, it currently yields around 3.5% in dividends. So if you invested $50,000 in SCHD a decade ago, today it would be worth roughly $150,000, and it would be throwing off over $5,000 a year in income. Imagine building that position up to $500,000 by the time you retire. Without touching your principal, you could collect about $17,500 a year, or roughly $1,450 a month, all while your investment keeps compounding. The companies inside SCHD aren't flashy tech startups. They're solid, established businesses that people rely on no matter what's happening in the economy. Names like Broadcom, Home Depot, Coca-Cola, Pfizer, and PepsiCo. These are the kinds of companies that weather storms because their products and services are always in demand. And because this ETF is spread across sectors like industrials, financials, healthcare, and consumer staples, you're getting a built-in layer of safety. With that, we've got our foundation and our safety net. But the third ETF is where we really start to push for outsized returns. This part of the portfolio is about capturing the fastest growing companies in the market. And historically, that's where the highest rewards come from. Now, in the traditional three-fund approach, this slot was reserved for international stocks. The idea back then was to balance US holdings with overseas exposure. But in today's global economy, the strongest companies already operate everywhere. Apple sells in virtually every country. Nike is global. Starbucks is global. And many of the world's largest, most innovative businesses are based right here in the US. That's why I prefer to replace the international slot with a growth ETF. My personal favorite is the Invesco NASDAQ 100 ETF, ticker QQQM, which is basically QQQ's younger, cheaper twin. It tracks the 100 largest non-financial companies listed on the NASDAQ, which means it's heavy on tech and innovation. We're talking Microsoft, Apple, Nvidia, Amazon, Meta, Tesla, Alphabet, the companies driving the future. Over the last 10 years, QQQM has averaged around 18% annual returns. That's huge. To put it in perspective, if you put $10,000 into it and earned 18% a year, you'd have about $52,000 after 10 years and over $272,000 after 20 years. Of course, there are more aggressive options like AI-specific ETFs or semiconductor funds, which have had monster years recently, but those can be extremely volatile. QQQM gives you a strong growth tilt with a long history of performance, which makes it far more reliable for a strategy that's meant to be simple and long-term. So how do you put all three together? Well, it depends on your goals and where you are in life. I like to keep it simple. In my own portfolio, I put 1/3 into each category, 1/3 in the foundation ETF, like VOO or VTI, 1/3 in the dividend ETF, like SCHD or VYM, and 1/3 in the growth ETF, like QQQM or VUG. This balance gives me broad market exposure, steady income growth, and the potential for high returns, all without having to constantly rebalance or chase trends. If you're closer to retirement, you might tilt more toward the dividend ETF for safety and cash flow. Say 40% there, 40% in the foundation, and 20% in growth. If you're young and want to be aggressive, you might do the opposite, a bigger slice in growth, maybe 50%, with the rest split between the other two. Let's run the numbers. Suppose you invest $500 a month evenly across these three ETFs. With a realistic blended return of about 11% a year, here's what happens. After 10 years, you'd have put in roughly $105,000, and it would have grown to about $170,000. 20 years, your $210,000 in contributions would be worth around $665,000. And after 30 years, you're looking at more than $2,300,000. all from 3 ETFs held long-term without ever picking a single stock. This is the kind of strategy John Bogle, the founder of Vanguard, was talking about when he said, "The majesty of simplicity." It works because it's diversified, low cost, and easy to stick with. But just because it's simple doesn't mean it's risk-free. Markets will crash. Dividends can get cut. Growth ETFs can have years where they lose 20% or 30%. That's why the mix matters. The foundation keeps you steady, the dividends keep you paid, and the growth keeps you moving forward. So now you've got the full picture. 3 ETFs, one simple plan, and a strategy that doesn't require you to watch the market every day or guess which stock will explode next. You've seen how each piece plays a role. If you found this breakdown helpful, hit the like button, make sure you subscribe and turn on notifications so you never miss a video. And if you're ready to go deeper, watch this next video right here.